I'm sitting down with Mario Montecinos. Mario Montecinos is a dear friend of mine. We met when we were in college. We joined the same fraternity. We were part of the same pledge class. And Mario has quietly built a large size real estate portfolio. He's in his 40s, very knowledgeable. And today we're going to talk to Mario about how he got started, where he learned, and also Mario is a lender. He does all types of loans, but one of the loans that we're going to focus in on today is hard money loans or private loans. And we're going to show you guys how investors are using private loans to build wealth. Mario's using them, all of his clients use them, and he's going to tell us when it's the right time and how you could take advantage of this. Mario, thank you so much for being here today.
Juan, thank you so much for having me. It's definitely an honor to be here, and it's a wonderful space that you guys have created. And I've been a big fan of what you guys have been doing and building, and it's really cool to knowing you at an early age in college and to seeing you grow your business and your brokerage, and it's awesome, and the people you're helping, and ultimately creating wealth and through real estate. So it's amazing.
Awesome, Mario. Well, let's get started, Mario. So, tell us about the first property. Your first. Well, I think your first condo was your first condo on Roswell.
That's right. Yeah,
1145 Roswell. Okay, so
you're
Mario, Mario's first condo. So, listen, Mario. A lot of times people are going to ask me. They ask you, "Hey, our condo's a good investment." Let me start there with you.
Sure.
Was that a good investment for you?
For me, it was, and it's an interesting story because I think getting in ownership, getting into wealth creation, if a condo is the vehicle to get your first piece of property, I don't think it's a bad idea at all. And why I talk about this before with people, and people are like, "Oh, timing, and when do I buy real estate? When do I not?" I think about when we bought that. I think it was 2004, I believe. And I thought it was the best idea, the greatest thing. There was appreciation. I look at this thing, I'm like, oh my gosh, there's $80,000 in wealth created, and I'm like, I only own this thing for a year, 2 years. I was like, this is amazing, and I'm just paying, my basic need, my shelter, right? Yeah. And at the time, I had a roommate, and then eventually a girlfriend or a fiance moved in, yeah. And I found a way to offset the monthly nut. So that was a cool thing. But then the market crashed, right? And then arguably for 3 to 4 years, it was like, this is a terrible idea.
Right. Okay. Right. All right. Well, listen, that's the purpose of this
Right.
podcast, is that we're not painting a picture that it's easy, that it's
Correct.
a slam dunk, that anyone could do it. Although I do believe it's easy, and I do believe that anyone can do it. And when I say anyone, I mean, Mario, you come from Riverside, really good family.
Thank you.
But I would say that I don't know that your family were affluent apartment investors building wealth through apartment ownership. This was not something you learned from mom and dad.
Not at all.
Probably something you didn't learn from any of your friends.
No.
At what point, Mario, did you realize, oh, I think this is the way to build wealth? Like, who and when did that happen?
Sure. Yeah. So to go direct to that, so a direct mentor was Mark Milan,
a mutual
mentor.
So we interviewed Mark earlier this week, and so yeah,
nice.
Yeah. So for anyone who wants to know about Mark, we interviewed him here. He's both of our mentors, and it was interesting. At that time, Mark is probably responsible for maybe 12 of us individuals, and he's really helped all of us kind of. Maybe realize, Mario, that we could become millionaires through owning apartment buildings. I mean, is that because that's kind of like what I like. He taught me that I could do it too.
Yeah.
So okay, so then I'll let you go back to Mark.
Yeah. So Mark, he exposed us, right? We saw the good, the bad, the ugly, and the upside, and the wins and the excitement. And I was to me it looked doable. Right. And I was like, man, you don't have to be a rocket science to do this, right? You can just have some disciplines and take on appropriate risk, right? And having an appetite for that. My father he is an entrepreneur. He did own his own business. He had a brokerage of sorts in custom packaging. So I saw him being an entrepreneur from that part. So that came in later, but the exposure of owning real estate, owning multifamily apartments, and the opportunities that could come from that. I was exposed through Mark Milan, and then And then we had a group of guys that were looking into this. And really, I remember graduating school 2004 or 2003.
2003.
2003.
Yeah.
And then from there, I went to Costa Rica for 3 months, and I was reading Rich Dad Poor Dad and The Millionaire Next Door, kind of like over and over and over again. And I was sitting there on this beach, and I was like, okay, it's time. It's time to get back and go to work and find a way to make revenue to put me into income, right? To put me in a position to buy my first piece of real estate. So
it's interesting, Mario. They always say, hey, like you're the you're the equivalent of the 5 people that you hang out with, and so at that time, I would say, it was me, it was you, it was Gavin, it was Andy, there was Marcus. So there was like a bunch of us, and then before us was Tim Reese and and maybe there's a few others that were in there also, just kind of learning and absorbing all this that Mark was teaching us.
Sure.
And we all kind of believed and we all did it. And now we're like, I don't want to say it's 20 years. Maybe it has been 20 years since we met him. Jeez, that's a long time. Okay. So, but it's interesting because I know, and, I want to talk to some of our listeners because maybe you're in a group of friends and they're saying it's a bad time to buy. There's no more good deals. All the wealth has been taken. This is only if you're rich. This is only if you come from money. That's not for me. Like there's people out there, Mario. Now we were fortunate that the group of friends that we had, we were like, we're more like like the Rocky and the Rudies of the world is that we didn't come from a whole lot. I mean, yes, we had loving, supporting families, but when it came to asking mom and dad for money for down payment, that wasn't going to happen for you, and it wasn't going to happen for me. And so, the thing is that we were fortunate, but I do want to tell people, like, you might be sitting around with a lot of friends who maybe don't have the same visions. And I don't want to say go get new friends, but maybe go find and join groups and meetups where people are like-minded, where people do believe it can't be done, where people believe that the American dream is not over, because I do hear that, and I hate hearing that, because I'm like, no, I could take a college-year-old, I could take 2 college kids, the Mario and the Wands of the world, and we can say this is what you got to do to build wealth, and 20 years later they're in another financial position, and it feels comfortable when you're there, right?
Yeah.
Mario, talk to us about your very first, I want to say that your first fourplex, was that on Gardena?
Yep.
Okay. Talk to us about that.
Can I circle back real quick to Roswell? Because I kind of ended it with like for 3 or 4 years. I bought the place. There was a bunch of appreciation. For 3 or 4 years, I was like, okay, what am I doing? I was literally hanging on by a thread to keep that property. I was able to negotiate a modification. And then that property ended up turning into being a rental.
Okay.
I moved out of the property. Eventually was able to have a couple $100 a month in the positive, which was amazing. And then eventually holding on to the real estate long term, I was able to sell it for a profit.
Okay,
right?
There we go.
So it was because I love talking about that, because it's like people like can get concerned and people are super smart about wanting to time the market, right? But I can, I feel confident like you can buy even in arguably maybe not the best time and still come out ahead with a game plan and the ability to hold on to the property.
No, and thanks for sharing that, Mario, because it's not all blue skies. And what you just described is the ups and downs of owning real estate, living in it, then renting it. And I'm sure, with any rental, you're going to have rental issues.
Sure.
But it's good to hear that, hey, you stuck with it, you didn't give up, and you were kind of dedicated, I guess, to the process. And I think if you were to talk to Mark, and Mark would say, if you sell it, you lose. If you don't lose. And like the only people who lose are ones who get scared during the down market, but no one's really forced to sell, right?
Correct.
And so that was well played. Talk to me about Gardena. What type of financing? I know you still own it, and what's interesting, Mario. So like I've had Mark Milan on this week. His first triplex, he lived in it. Another really successful investor that's a friend of ours, someone that we work with, Brad Johnson, coming out of UCLA, his fourplex, he lived in it. It's like this pattern.
Sure.
Was that your pattern?
Correct.
Okay.
Yeah. So the first fourplex, I remember being in escrow on this and negotiating back and forth. And my agent at the time, which unfortunately wasn't you, should have been you on that one. But my agent at the time was like, because we were doing the request for repairs and the property was beat up, and he was like, man, I don't know if I would buy this. I was like, are you kidding me? Like, you're my agent, you're telling me that? But for me, I saw it was a FHA 3.5% down at that time. It was price points and everything else. It was a lot easier to do. So you own a fourplex building with 3.5% down. And for me, I was like, man, that's a beautiful leverage. And to get a 30-year fixed mortgage.
Hey, okay, well, hold on.
Yep.
When you say leverage, so like in your mind, you're saying, man, I'm only putting 3.5%
Right.
down. And when we use the word leverage, what you're saying is essentially, I'm putting very little down and all the risk is on the bank who's going to give me 97%.
That is correct.
Essentially. Okay,
I
cool.
was like $25,000 and I own a $530,000 income producing property. I was like, I love that. I love that idea to have that. And there's already tenants in place. And the other thing where most people, or not most people, just it's a consideration is I'm buying this thing, but there's no cash flow, right?
Yeah.
Like, why am I gonna do that?
But okay, a couple questions. Okay,
Yeah.
How old were you?
I was at that time, so that was 2013.
Okay.
Yeah.
Okay. So then, okay. So, I mean, 30.
Yep.
Okay.
Right.
All right. So you're 30. You're 30 now.
29,
Yeah. And then you come in with 3.5% down. You brought up cash flow, which is obviously everyone. That's the first thing. That's the first thing that comes out of someone's mouth is that does it cash flow? Does it pencil? And so let me ask you: did Gardena, your 4-unit, did it cash flow the day you bought it?
No, it did not.
Oh, it didn't.
No.
And you knew what you were doing because you were already a lender at that time.
Yeah. I was a lender at the time. I mean, I understood financing a lot better because at that point, so I got in financing in 2004. So, I had some time seeing that and more time exposed to, other investors and whatnot. But I mean, that was my first fourplex, property at the time. But I understood and appreciated that there's a road to get to, right?
Yeah.
And I see the plan of like, okay, you improve the property and you get to market rent. Like at that time, like that was like, it seemed like it was going to be work, but it didn't seem like something I would be afraid of. Right?
You know what's interesting is that the same business model of 30 years ago, 20 years ago, 10 years ago, the same business model that you had was buy something with as much leverage, so with the biggest loan possible, and try to get the rents to come up.
Right.
Did you know that that's the same game plan right now today? That nothing has changed in the business model? So when you say that it's not rocket science, it's literally not rocket science. And so many people have done it before all of us, and nothing has changed. Like the exact same way that we analyze properties 20 years ago when Mark taught us is the exact same way we analyze now. And 20 years ago, the properties that I was buying and you were buying did not cash flow. They're not cash flowing now. So it's so interesting. And I know we tell people this, and you're on the lending side, I'm on the brokerage side, and we're helping individuals build wealth, literally teaching them what Mark taught us, right? He was essentially our coach. And then they don't believe us. Or they think we're trying to sell them on something. But I'm glad you said that Gardena didn't cash flow at first. And at what point do you believe that it started to cash flow?
You actually helped me out with the management on that property initially, and it was pretty. It didn't take that long. I mean, it was probably under a year at that point because it was only, I think maybe 500 or so under what the mortgage was with the principal, interest, taxes, insurance, mortgage insurance, the whole monthly payment. It was it wasn't. I mean, but still at that time to be 400 or 500, it's an investment. You're thinking like, oh, so that's like a car payment. I could be rolling a BMW, right? Do I want to roll in a BMW, or do I want to buy an appreciating asset that very shortly is going to actually start paying me versus me having to make a payment? So that was a choice.
So just to be clear, Mario bought this 29 years old, and he's negative $500 a month. Because some people are like, I'm not buying anything that doesn't break even. I'm not going to do it. Sorry, Juan. And here you had the training for Mark, and you still signed up for something that was negative $500 a month. Now, I normally tell people, hey, let's correct the property. Let's make that gap of where the rents are today and where they should be. But let's give it 18, 24 months. You were able to do it under 12, which is great. You also were able to buy with 3.5% down, which back then we did meet the self-sufficiency test, and you were able to do it. Now and I know that's nearly impossible.
Right.
but there's also a new program.
That's correct.
Talk to us about the new program. And I know you just utilized it again, because here's the other thing that I'm going to ask you. Okay, you know what you're doing. You now own a lot of properties, and so talk to us about this new program and how someone could do what you did, whatever, 15 years ago.
Yeah, it's amazing. It just came out. I think November 18th is when it became available. So just of last year in 2023. Basically, it's the 3.5% down FHA program on conventional. So it's conventional financing, and you can do it with 5% down. It does have to be a primary residence, right?
Yeah.
So there is, the appropriate person that needs to have that be their primary residence and move into it, right? But it's the same idea, and actually, I think it's a little superior versus the FHA deal because possibly, when it comes to a point where it has the appropriate equity into the property, it's either 20 or 22% equity in the property, then the mortgage insurance can be removed. Versus FHA, it's a little trickier to do that. So there's even more hope to free up the cash flow.
So although getting a fourplex under FHA is not possible right now because the values are high, the interest rates are high, there is this alternative that anyone could be using. So if anyone says, well, I can't pull that off, the answer is yes. And something happened in November of November of 2023, and you were able to just utilize it recently, right? Mm-hmm. Because there's different ways now. Because some people are going to hear this and say, well, I already own a home. The bank is not going to believe that I'm going to live in a fourplex. But kind of tell us about the strategic way that you managed to buy another fourplex recently. This year, right? Was it this year?
Yeah.
Okay, so it's March 2024, and Mario continues to purchase, kind of under the same business model from years ago. Talk to us about that.
Yeah, so I'll be very clear. So I partnered with that property. So I partnered with a gentleman that I do a lot of business with, and there's a relationship there. We talk on a daily basis, and there's trust in that relationship. And he was the buyer, right? And then we outside of it have an agreement from that perspective. So he is a buyer. He doesn't own any real estate. He's moving in the property. So that's why that fit. If you own the house. If you already own a house and you're looking to do that, it's really hard to do. Like it almost pretty much doesn't unless, I look back, I kind of was in that predicament with Gardenia, the first fourplex. And so I moved out, I rented out Roswell, and I was renting in another property. That's really the only way if you already own real estate where I think that's going to like really be real. Right. So,
yeah. So let me give a little more information on whether if you're someone like Mario who says, man, I want to take advantage of this 5% down, and anyone who everyone should be taking advantage of this. Now, if you're not in the position to be the one who occupies it, maybe you find someone. Correct. Maybe you find someone and that's what Mario did. He found someone that says, so in this situation, Mario says, well, I can't own it 100%. But man, if I own 50%, which is the agreement that he did with his partner, it's perfectly fine. And I suggest anyone who wants to get started, either find a mentor or find someone you can partner with if you're afraid of doing this. Because I tell people I'd rather own 25, 33%, 50% of something than 100% of nothing, right?
Great.
And so I love that program. I think more and more people need to utilize it. I think that the biggest hiccups we have right now is that people say, well, the payment's too big. And then I'm sure that your same business plan is, okay, the rents are low. Let's find a way to get them to market.
That's correct. Right. And I look at it for, all the challenges of like, oh, it's so expensive to purchase a home. And I agree, it is. Like from where people's rents are to what their new mortgage payment, there is a big step. There's a big leap. Just say, for example, somebody's paying $3,000 in rent or $2,500 to $2,800 in rent right now. And then to own a home, they're going to be at $7,000 or $8,000, right? In their monthly mortgage payment. Like that's a big leap. For me, a direct solution to that is to purchase units, right? If you're already in an apartment or a small house, the transition from that to another apartment in the fourplex or the triplex or the duplex, the timing of it, the transition is not too far out of whack, right? And then you move in, you rent the other units out, and then your actual monthly net is something maybe more like, 4,500 or something like that. So to get in the home ownership game, to own multiple units to where you're going to have rental income down the road, where your monthly payment is going to be affordable because you have others offsetting the rent. And then eventually, maybe a year later, you move out and then you put yourself in a position to buy the next piece of real estate, right? And then you got, units turned. You have market rent that's starting to come in on that, and now you're in a position to move out. And I think a lot of what people think, they think everything, whatever they're doing is forever, right? Moving into this, I don't want to live in a fourplex forever. Like,
Yeah.
you have to get over that, right? You have to understand that like a year comes and goes, right? But a year down the road, you put yourself in that position. Now you're controlling a $1.4 million property, and it's, on the road to getting cash flow on it. And then you move out, and now you're in a position to buy the next piece of real estate.
Got it. Got it. Mario, talk to us right now. A lot of your investors are using private loans, hard money loans. So these are loans that are, um, I guess, out of the box type financing. It's typically when a property needs major work. Maybe sometimes an investor doesn't have the 50% down to buy an 8-unit building. There's pros and cons to these types of loans, but I mean, Mario, you're in a position where you see a lot of successful people utilize these
Mm-hmm.
in the right way. So kind of give us some like high level tips of hard money loans and how someone who's never done it, how they could get started. And yes, it costs more. I mean, let's just put that out on the table.
Sure.
I don't want to get a hard money loan. It costs too much. Okay, well, do you want to build wealth?
Mm.
Or you just want to sit on the sidelines and watch everyone else do it?
Yeah, it's that idea is, yes, a hard money loan. So a hard money loan is typically requires a lower down payment than traditional financing. A hard money loan is a lot easier to qualify for. You don't necessarily need tax returns or W-2s or any traditional income documentation. The lender or the high net worth individual who's going to be lending this private money, this hard money or bridge loan, right? Let's just stop right there. So kind of synonyms here, same kind of category. You have hard money, you have private money, and you have bridge loans. They are more along the same idea, right? So whenever you hear that, we're talking about the same kind of financing for the program. So the whole idea of why do a hard money loan, one could be the condition of the property. A lot of times the banks on full doc traditional financing will not be in a position to lend on the property because of the current condition of the property, right? So then automatically that financing is out the door. That's number one. Number two is if you're looking for leverage, that word again, the beautiful word of real estate leverage comes up again. If you're looking to control a property with the least amount of money down, a private money could be a great tool. Let me give you an example. So in residential 1 to 4 units, they'll typically allow, with a little bit of experience, you can go up to like 15% and sometimes 10% down, right? So $1 million property, you put down 150,000 or maybe 100,000, right? If you're an experienced investor, you get a little bit higher leverage, which means a lower down payment. And you compare that to traditional financing. If it's an investment property, the same $1 million property, you would need, close to 250,000 down, right? So you keep more cash. The other beautiful thing about a lot of private money loans, there's fix and flip. You can get money on a construction draw basis to help finance the project. So let's say for every 100,000, you're able to recoup 85,000, or sometimes even up to the whole rehab budget to do that. So you buy a property, they give you the loan to close on the property, and then also you can draw on your construction budget to help finance that actual property and into building value adding to the property, which is really, really cool because there's something that's very, very important when using private money. So private money terms are typically on most 12 months, and they can go up to 36 months on most stuff, right? So that goes fast, right? So you need to have a strong exit strategy, right? And what is an exit strategy? Are you going to be selling the property, right? Are you going to fix it up, add value, and then sell the property? A lot do. Or are you going to be fixing it up, adding value, and then refinancing to long-term debt, right? Which I love that idea. as well, right? Both are strategies in plays depending on what the investors is looking to accomplish and their goals. But adding the value, let's talk about fixing and renting out, right? You fix up the property, and now instead of the property worth $1 million, you drop to 150,000 into rehab the property. Maybe the property is worth 1.4 or 1.5. So now you can go and refinance, right? When you go to refinance, instead of getting financing where the property is only worth $1 million, you're refinancing when the property is worth 1.4 or 1.5 million, right? And that puts you in a much greater equity position that takes risk off from the bank, and they're much more willing to lend, right? Because you've created that value, you've created that appreciation in the property because you've improved the property, and then also, you move the income up.
Mario, for someone who's never done a hard money loan, but maybe they live in an area near their mom's house, and there's always this house that needs so much work, and they think they could get a good deal because they know the owner wants them to buy it, but maybe the owner has let the property go. The roof is caving in, they've ripped out the flooring, financing doesn't seem possible. How does, I guess, what would be someone's first step having never done it? Like, do they partner with someone, Mario, who has done it? Like, do you guys give loans to someone who's never done this?
Yeah, I do have a capital partner that will do it with no experience, and they're heavily underwriting the actual project, right? What they're buying for, what the after repair value is after they fix it up. They will look at the borrower's credit score. When there's no experience, ideally there's a minimum 650 credit score. So that would be, credit score is important. The equity built in the property is important. But to answer your question, yes. I mean, I do a fair amount of people that are doing their first. Yeah.
Mario, for someone who's listening to this and would like to get a hold of you, I mean, I guess I have two questions. Obviously, we're in Southern California. Can you do nationwide loans?
Yes.
And what's the best way for them to contact you? We are going to put your information in the show notes, but
Sure.
do you want people to email you? You want them to call you? Let's just say someone says, man, I know of a house and it needs tons of work and I thought I could never buy it. And you're going to say, yeah, you can. This is how investors do this. Because that's the benefit. And like the one thing that I want people to know is that Mario is not just a lender. He's an investor. He's utilized these hard money loans for himself to build wealth. So that you're talking to someone who has the experience, who's walked the walk. And so best way to get a hold of you.
Sure. I mean, simple. You can just send me a text, 562-787-8902. And then if you want to send an email as well, you can do mario@marioloans.com. And look forward to be a resource for you, give you whatever I can to help you. And just have an honest conversation and see what you're trying to do and see what I can do to help.
Mario, I'm going to give you the last word, but here's what I would like for you to maybe answer. What's the ultimate plan for you? Everyone has a different plan. Your early 40s, you've built the wealth, you have a successful business, people trust you. Where do you go from here?
I want to, continue rinse and repeat what I'm doing, but I also want to, be able to be in a position to give back more. I think serving communities is super important. We got a lot of homelessness going on and it's continuing to grow. So I think that's important to me. But also from my wisdom that I've been building and I have a lot more to learn is just to pour back into people. And I believe in real estate long-term, and building wealth through real estate is amazing. And my goal is to be, have X amount of passive income. So, I could be even more available to help more people.
I love it. Thank you guys. Mario, thank you so much. To our listeners, make sure to subscribe, make sure to like, make sure to comment. That's all for now. Until next time.